just worldwide markets. I know that the summer vacation has started, at least here. My kids are out of school, and it's time for everybody to think of terms of things of the beach in the summer, and hot weather, and air conditioners, and things like that. Unfortunately for the world's central bankers, that's hardly the case. They're certainly busy and worried on both sides of the Atlantic. Here in the States, perhaps less worried, and in Europe, all-consuming. But let's deal with what's going on in the United States as well. We'll talk about it. I mean, it's difficult. It's impossible to really talk about what's going on in the U.S. or potentially in the U.S. without factoring in the rest of the world and vice versa, of course. So we will have to deal a little bit with the news out of Greece today, which is fascinating, as always, although a little bit old at this point. The Fed, just some notes. If anybody has any comments or criticisms, please type them in. I'll be glad to stop and deal with them. I prefer to run these webinars as a colloquium, as we say, rather than as a lecture. So please feel free to interrupt, and we will talk about topics, whatever you'd like. The chart you have in front of you are the world's major central banks with a few representative ones. The squiggly one are the Japanese, the BOJ. The white line is the Fed. The yellow line is the Euro. Green is the UK. Red is the RBA. Orange is the Bank of Canada. And just to show you some of the potential effects on the rest of the world, after all, the Western developed nations are hardly the sum total of what goes on the planet, is the Bank of Brazil, the Selic rate. You can see just on this chart, without a great deal of analysis, that the Fed policy, followed by essentially every other central bank in the world, has not had a uniform effect around the world. If it had, then you would not see the Selic rate skyrocketing like that and the reasons for it. But let's step back a little bit. I titled it today, The Fed Against the World. There's only one central bank in the West, of course. We have the Selic rate in front of us, and there have been other banks as well that have raised rates in the developing world. The Koreans, I believe. And the reasons for those we'll get to in a second. But on the central bank side, on the Fed side, you must look at the Fed's policy right here, white line. Went to basically zero rates as long ago as how many years? 1, 2, 3, 4, 5, 6.5 years of essentially zero rates. After that time, we can certainly make a few statements about the efficacy, the economic efficacy of zero rates. One, now we're not going to deal with counterfactuals because the counterfactuals is the Fed's best defense. But I don't want to do that because you can't calculate counterfactuals. Had a battle gone differently, had Harold won at the Battle of Hastings, the history of England would certainly be different. There's no doubt about it. But he didn't, and his army didn't. And Napoleon won at Waterloo. You would have a different history on the continent. But those things didn't happen. So I resist, and I'm going to resist, although they are good bases for novels. I read a novel once called The Difference Engine by William Gibson that took as its world, I believe in the 1880s, an America that had a successful Southern secession. So the United States was actually two nations. And how that changed. Fascinating. And it wasn't all that extreme as far as what was possible. But anyway, I do not want to do that with banks, and I certainly don't want to do that by giving the Fed the benefit of their own doubt, which they're forever taking anyway, so they don't need me to assist them in that. One of the things which we can certainly come to, I think, a fairly agreed conclusion is that low interest rates, quantitative easing, excessive monetary pumping for the economy does not and cannot, no, let's not say cannot, does not create robust economic growth, and it does not create a robust recovery. You can argue that there are other reasons for this, but it is certainly true that it is not of itself sufficient in this situation, and I would say any other situation, to provide the impetus, the rationale, the animal spirits for economic growth. U.S. economic growth has been half, approximately, what it has been in prior recessions. I know the defenders of the Fed. I'm not saying that the Fed should have done anything else, but I am saying that the prolonged period of economic malaise and its response by the central bank, the rates, has been unprecedented in its effort and also unprecedented, if you will, in its failure to produce economic growth, not only here but around the world. Whatever's going on, it is not sufficiently addressed if we use the standards of prior recessions. It is not sufficiently addressed the problem, which the United States is woeful low economic growth. So considering that record of 6 years of mediocrity, I mean, there's no way around it. This is the record. You can argue about the reasons, but this is the record. The Fed must be the most blushing bride of any central bank to ever attempt to raise rates. It's astonishing how reluctant and fearful the world's leading central bank appears to be for a quarter-point rate hike from 0.25 to 0.5. They do not want to do this. But they know they must, or they feel they must. And the reasons are, I mean, when I came in, the Dow was down 180-something points. Largest reasons for that, though, are because of Greece. But Greece is actually both a cause and a symptom of what's going on. The idea in my mind, and I've written about this a number of times, and certainly recently, that a default by Greece will not create havoc in the world financial system is something I just don't believe. I don't believe the European banks are adequately capitalized for it. I think that the ramifications of something like this are essentially unknown. The confident tones you hear from politicians and bureaucrats and Germans and others on the continent that this is not going to be any problem, it's not something that I buy. So we will see. Maybe we will. But the reason that this is such an issue is what the Fed is telling you. I'll put it another way. You know this is such an issue because the Fed is so extremely reluctant to raise rates. Now, this chart only goes back to 2007. I took it just before the financial crisis. But if you took this chart back to 30 years, back a generation, you would get an even better sense of the historic nature of what the Fed has done. And I focus on the Fed because the Fed is the leading proponent, both intellectually and empirically, meaning in action, of this policy of zero interest rates and quantitative easing, which is essentially zero interest rates even lower. The reason they did quantitative easing is because you can't lower rates anymore. So to get rates down, you have to do something else. And what do? You intervene directly in the bond markets. You directly go and buy bonds. It's what the ECB is now doing, although they're running out of bonds to do it. And it's also not had nearly the effect that they want to. And in the U.S. it had. German rates popped, I believe, last week or the week before, popped over 1%. That would not appear to be an effective quantitative easing program, would it? Since you're supposed to bring rates down. But be that as it may, let's leave that alone for a minute. Why? Why would the Fed, one, want to raise rates? Well, I mean, if zero rate policy, at least it may not be producing gangbuster growth, but it's growing. The U.S. is growing 2.2, 2.3%. We've supposedly created all these jobs. I say supposedly because the jobs numbers in the U.S. are the most massaged numbers the U.S. produces. So why change? If it works, if it's not broke, don't fix it. So why does the Fed need to raise rates? Let's approach it that way. This may not be ideal, but the world's not falling apart. At least we don't think it is. The U.S. is growing, not much, a little bit more than inflation. Job growth, certainly in the official government statistics, has been good. So why should we raise rates? There are more than a few people out there, especially in the stock market, who will say exactly that. Why should we raise rates? What's the point? And without even taking the negative argument is, which I'll approach in a second, well, the economy is really much weaker than it looks, so we don't want to raise rates. But, of course, the logic of that is faulty. Because if after 6.5 years of zero rates, the economy is still weak, why, logically, would you expect more zero rates to do any good? What change in economic behavior on the part of the country are you expecting when you're continuing the same policy which has not generated any results or marginal results till now? It's that old quip about definition of insanity, doing the same thing over and over again and expecting a different result. Well, you have some of that with zero rates policy around the world. They have not produced the economic growth and the economic recovery that they were seeking. And this is not simply a criticism of the current state of affairs, but the Feds, and I'm again picking on the Fed because the Fed is the leading proponent of this. The most effective way to chart what the Fed thinks it's doing and what actually happens is just to look up a history of the Fed's own economic projections. And every year, they are demolished by reality. For how many years now has the Fed been predicting that we're going to get growth at over 3%? We haven't. On occasion we have, but it's never steady. It's not the kind of self-sustaining growth that everybody talks about. So with this consideration, logically, of the Fed having, by their own standards, the standards of their own expectations and predictions, not mine, theirs, a marginally successful monetary policy, marginally at best, you have to wonder where the logic is that we need to end this policy. So where does that come from? It certainly doesn't come from as the Fed likes to say, any data dependency. Yes, job markets have been better by the BLS. Is it BLS? Yes, the BLS highly massaged, highly seasonally adjusted job numbers. But when you look at the balance of the economy, that has been, over the past 18 months, the only steadily improving, steadily upwardly mobile, if you will, economic statistic in the United States. Almost all the other ones are performing either poorly or some actually declining. Let's take a look at one or two of those right now. These just happen to come out today. Industrial production for June. Let's look at monthly first. These are the actual numbers. I thought I'd put them up. This is from Bloomberg, of course. So we have 1, 2, 3, 4, 5 months, of which 4 are negative. Today was expected to be up, and it came in 0.2 down. And if you stretch back even further, there's a run of negative numbers here, here. So there isn't anything in industrial production. Let's take a look at the chart here. It's the wrong one. I want to have the chart here. Hang on. The visual presentation. Oh, I did that twice. How about that? Here we go. Okay. Industrial production numbers. Now, the reason I prefer and don't often come up with sentiment numbers, look at the ISM numbers, Institute for Supply Management, their Purchasing Managers Index numbers, the consumer satisfaction numbers, consumer sentiment surveys. The reason I prefer not to deal with those as much, I will cite them as secondary sources, although many people will, of course, cite the immediate numbers as something going on. Let's take a look. This is May. These are not really retrograde numbers. May is only last week. 2 weeks ago. So they're relatively recent. It's not like some of the housing numbers that you're talking 3 months in the past. But these are actual numbers from the economy. They're not surveys, in the sense that surveys go out and ask various professionals what they think about the economy, how's their order book, things like that. These are actual numbers. So this is the industrial production number, and this is a more concerning number. This is the year-on-year industrial production number. These happen to be out today. That's why I chose them. Is this, perhaps, what the Fed is concerned about? We have another one here. Factory orders. Oh, factory orders. Year-on-year. A lot of this one right here, of course, is the base effect from the collapse during the recession. But this is not a base effect. So the Fed is looking at these numbers, and it has to come up with the logic behind them if it's going to tell everybody, as it has been, that it wants to raise rates. Because the logic is difficult. Because it's not continuous is what the problem is. If we look at the Fed's rationale for the past 6 years on zero interest rates, that they're necessary because the economy is weak, essentially. Then you take a look at these numbers, and how does the logic previously presented to the public, to Congress, to all of us, that we have zero interest rates and quantitative easing because the economy is weak, that apply to this situation? It would appear logically that if the economy was weak then and the answer, the prognosis, the medicine was zero interest rates, then why in this situation with factory new orders below prior levels
and sinking, apparently, why would you change your policy prescription? If you needed zero interest rates when the economy was doing badly, though better than it is now, apparently, why would you change? This is a point that the Fed, in all its great communication and transparency, which, by the way, is a load of nonsense, has not addressed. Because they can't address it. Because the only place it leads to is a critique of their zero rate interest policy that it was a failure. Because if we are considering raising rates, right now the U.S. GDP is, 0.7 in the first quarter negative, and it was tracking 1 point from the Atlanta Fed Now GDP Now thing, which was the most accurate one in the first quarter. It's tracking 1.9. So we might have a half year, just based now, of 1.2%. And I haven't seen a single good logical explanation other side the fact that it snowed in the wintertime, which it does on occasion. You know, I may have mentioned this last week or last seminar. My girls and I are reading, this is for the Americans out there, you forgive me, Laura Ingalls Wilder, Little House on the Prairie. It was a Michael Landon series back in the 70s, I think. But it's a story. It's largely an autobiographical series of novels, or series of books, 8 books, I think, about American pioneers post-Civil War in the upper Midwest, Wisconsin, also into the central part of the country, the Dakotas, and I think Kansas. And it's astonishing to read, particularly one book, almost the whole book, called The Long Winter, where they are in uninsulated, what we would undoubtedly call shacks, in the central plains of the United States, and the outside temperature is 30 degrees below zero. If that fire goes out in the stove, then you freeze to death. That's it. And so I think of that, and then I think of the logic, and where I was reading this last month and during the winter, the logic where you have 4 or 5 months of very weak economic growth and nobody has a clue why, and nobody has a good answer, and perhaps behavioral economists, which I'm about to start reading, might have an answer for it, except that it snowed. So it would seem to me that without a better sense of what happened in the first quarter and into the end of the end of the last quarter last year, a policy change, a prescription by the Fed seems a bit dubious. So let's look at this right here. This is just one thing. These are factory orders. Or let's look at which ones are these? Oh, yeah, those are those. Okay. Capacity utilization. Look at this. From the end of 2014 to now, the utilization of the, and again, these are economy-wide numbers. They're not highly seasonally adjusted as far as I know, and they're simply reports. They're not surveys. It's like, the consumer sentiment surveys come out, and they ask consumers what they think inflation is going to be in 5 years. Completely useless piece of information. The Fed has no clue what inflation is going to be because they keep getting it wrong. So why bother asking consumers where they think inflation is going to be in 5 years? I suppose the logic is that whatever they say will reflect back on current purchases. I don't buy that at all either. So those kind of sentiment numbers are things that I tend to not quite ignore, but to discount. However, this is a report. So this is capacity utilization. Hit a peak back in the last quarter of last year, and it's been down steadily since then, back to where we were in 2013. Well below what it was before the recession. Okay, let's take a look at this. Factory orders, and then we're going to look at industrial production. Remember, this is base effect here through here, not base effect. was a relatively short base effect because this was very deep, but relatively quick. So here we are, down 6.4% year to year, below anything we saw prior to the recession. Okay, let's try another one. Industrial production. These charts are all depicting something that is going on in the economy, the U.S. economy, that is not adequately explained, or perhaps is being more than adequately ignored by policymakers. And the logic, of course, is, as I said, one is that if zero interest rates are the prescription for weak growth, then why would we be taking away zero interest rates at this point? Now, when people from the equity side say we shouldn't be raising rates, all they're talking about, of course, is the penchant for zero interest rates and liquidity to support the stock market. That's their interest. That's their sole focus. Those comments, as far as economic analysis, should be discounted. On Wall Street, everybody talks their book, whether they're on television or at the dinner table. Everybody talks their book, and that's the largest portion of that. So on one hand, we have the logic where weak economic growth economic prescription is zero interest rates. So we're just going to have to set aside that whole way of looking at things, because there's zero way to depict the current state of the U.S. economy as robust. And if you don't have a strong economy, and the prescription historically for 6 years has been zero interest rates, it is inescapable that you should continue those rates as far as your prior logic goes. And the Fed is not doing that. At least they're not saying they're doing that. They seem determined to raise rates. So why? Now, the problem for the Fed is threefold actually. First, they're trapped by their own logic, what I just outlined. If you have weak economic growth and the policy prescription are zero interest rates, then why are we changing? We still have weak economic growth. Two, the possibility may have dawned. Well, let's deal with the immediate one before that. There are a couple other reasons. The first one, and the weakest one for raising rates, is that if you actually get a recession, which, by the way, we're going to have sooner or later, because recessions are part of the business cycle, and we have not abolished the business cycle. Whatever Mr. Greenband started to say, and others have followed, the idea that we've abolished that is nonsense. Okay, so a weak reason for raising rates is the Fed wants to be able to cut rates. Well, that's a very weak reason, because in order for that to be true, the Fed would have to get up something in a relatively short amount of time to have any effect when they cut to a relatively historical level of the Fed funds rate, well over 2%, in order to have any effect when they cut rates, any economic benefit when they cut rates. So if the Fed raises rates in September, 1/4 point, and we have a recession in January, are you going to cure the recession, or at least help to ameliorate the recession by cutting rates 1/4 point? It's not going to make a bit of difference. So that, I'm going to get to that in a second. It's very interesting. So the fact that they want to raise rates so they can lower rates is largely nonsense. It's not true. One possibility is that the Fed is concerned that what they wanted to achieve, which they have achieved, the wealth effect, supposedly, by getting the markets up, we all feel better by piling people into risky assets, which whatever anyone says, remember, please, equities are considered risk assets. They're not bonds, which you can hold, all right? It's not owning property. They're risk assets. And the Fed has pushed their zero interest rates, without question, has pushed money of all sorts into chasing yield. There's one of the worst, in my mind, investment strategies you can have is to try and chase yield. Because the only way to chase yield is to go further out on the risk parameters. People that shouldn't be there. So is the Fed now concerned that this has happened? Yes, I'm sorry, everybody. I know what the issue is. I mean, I don't know what the issue is, but I'll just say this. I had to go directly to the URL logon. I believe FX Street is having some issues today. I don't know what they are. I apologize for that. I know the people at FX Street. I'm sure they're working on it as best they can at the moment. But there are some issues with logging on to FX Street today. I could not get through their website. I had to go call them up and get a direct link. So I apologize for that. But we all know how reliable and valuable FX Street is, so everybody gets a few dispensations, I guess. Okay, so this possibility for the Fed is that they're now worried that their logic has produced equity bubbles, frankly, around the world. Might also say a bond bubble. Are they afraid that there will be some sort of comeuppance for this? It's decidedly possible. They have made various comments over the years about exuberance. I didn't think they used that famous Greenspan term, but anyway, about inflated values in the equity markets and in various other trading markets. They cannot come out and say that. They're trapped by their own rectitude. The idea that the Fed commits transparency is nonsense. They do not. Now, they may be unsure themselves, and frankly, I think they are unsure themselves. I think they have discovered that when you ruthlessly and for such a long time misprice the key ingredient, the key input in a capitalist economy, the price of money, you end up with all sorts of unusual and unknown consequences. And I think they are discovering that. So, that the issue that they are concerned that these bubbles are getting a little out of control, you can always look at the Chinese stock market. If you on the Shanghai and the Shenzhen and the Shanghai exchanges, you want to look at a bubble, go check those out. The Western exchanges are nothing compared to those. The last reason, one which is not something they have mentioned at all, but I think it's true, is what I just said. I think they may be coming to a moderate realization, and not one that they're ever going to admit, that the problem with economic growth in the developed worlds is their policy of zero interest rates. It has gone on far too long, and it has twisted the economy into chasing market yields rather than economically beneficial investment. If you want to know why, this is my opinion. I can't prove this, and I certainly don't know what the Fed are talking about at their FOMC meetings. And remember, those minutes when they come out are highly edited by the Fed itself. So, the last possibility for the Fed is that they are beginning to realize, maybe empirically, if nothing else, as in look at the evidence and say, hey, we have to explain this evidence in front of us. We have subpar growth for 6 years. The 6 years exactly when we are running zero interest rates. Now, you can make, the Rogoff-Reinhardt argument that after a balance sheet recession like this, growth is always slow to recover for a long time. That's the natural effect, the historically documented effect, I think is what they would say, of this type of economic catastrophe. I've not heard the Fed make that argument. I don't think they will. But as far as their defense goes and the policies, that's probably the best argument you can make, because the corollary to that is that it's the Fed counterfactual, that nothing else would have done any better, and other policies would have done considerably worse. That's one argument. The other argument is that the problem with economic growth is specifically, or at least largely, the zero interest rate policy itself. What it does is it prejudices financial institutions, banks, hedge funds into chasing yield. Free money at the Fed, looking for return. That is not money that will be used for productive investment. Same with companies and their share buybacks. There are two ways to get, I guess there are three ways to get stock prices up. One, you can have a generally rising market because of something the Fed's doing on policy, that we have. Two, you can invest in R&D and in new plant and equipment and actually make more product and make more profits. Or three, you can you can borrow money for no cost and buy back your stock, and that drives up the price. And unfortunately, companies have benefited from number one and number three, a generally rising market because of Fed policy, and a generally rising stock price because of company buybacks. Neither one of these are productive investments that produce jobs and income. Yes, I know the last income numbers that came out were, I believe, 1/10 better than expected for the month. And so the endless chorus of boosterish commentators were yet again saying that the jump in wages that you would expect from a tight labor market, provided, of course, the tight labor market is accurately portrayed by government statistics, of which I have my doubts, is finally here. I can't tell you how many times this has been said in the past 6 years. It does not seem to be true, and my venture is my guess it's not true this time. Income has barely been keeping pace with inflation. If there is increased spending in the past few months, it has to do with a large increase in revolving, that is, credit card debt. We have yet to see the type of sustained increases. One thing you have to remember when you talk about income here in the United States, that the scale of annual increases have halved over time since the recession. If you want to look at why we're not getting robust economic growth, that's the reason. And then, of course, you can go back a step further and say, well, why are we not getting that? But compare it historically, the growth rates are close to half what they were before the recession, going back into U.S. Generational economic statistic history. Something has changed as far as the remuneration given to workers in whatever fields here in the United States. Okay, and other places around the world. There's a question or two, I just want to look at them. That's a very interesting topic. We have, of course, I've been dealing mostly here with what if they take no action on interest rates. I've been dealing here mostly with American statistics and trying to outline what the Fed's dilemma is. But there's, of course, another dilemma, and it may be even bigger, and it's Greece. It is, as I have written almost every week for the past 6 months, something on this. It is impossible for me to believe that a default by a major European country, not major, but a European country, major as far as the world goes, only in the sense that it is part of the European Union, a developed nation. I am tired of people calling Greece a third world country. It's not. It's an absurd statement. But the idea that a default of Greece's debt, now, countries default all the time. Some of them more than once. And the world doesn't fall apart. What happens? What always happens when a loan goes bad? The bank writes it off. If it doesn't have enough capital, the bank goes under. That's what happens. That's what capitalism does. That's how you get rid of bad banks. Problem here, of course, is that the sovereign debt is all backed up by taxpayer money in Germany and other places. And the politicians don't want to tell those people the truth. These loans are dead. They're never going to be repaid. And the chances are the interest rate isn't going to be repaid either. Why? What has Greece been doing with the money it gets from the Europeans? It sends it right back to the Europeans. It's absurd. Tsipras is right as far as his long-term analysis of the damage that the loans and everything else. Yes, it is true. Greece practiced bad bookkeeping. But the Europeans knew it. So there's plenty of fault all around. Nobody comes off unscathed. But I think the political opinion in Germany is such that they say, we're not giving them any more money. Let them go if they're not going to pay this stuff off. And they're not. So it's difficult to tell at this point whether this is a bluff or not. But either way, the turmoil heading into this, and the more you hear about the reports on this, the more intransigence there seems to be on either side. And Greece, I suppose, I don't think anyone in the market, Euro, when I came in here this morning, Euro was still trading on a 112 handle. Until you see Euro at 105, nobody is buying that this is anything more than negotiating tactics. Because if the euro's not collapsing, then the market is simply not pricing in. And everybody remember this. We can talk about the euro for a minute here, because I think it relates very specifically to our Fed problem. But if the euro is not sinking, then the market is not pricing in a Greek default and withdrawal from the euro. Period. Now, it doesn't have to go to parity, because that would be when it happens. But the apparent intransigence on both sides and the very much hardening rhetoric and the inability to find any common ground. See, the thing is, the Europeans want them to cut Greek pensions. What they say, of course, and I don't know how accurate this is, I'm just repeating it. What the Europeans say is that the Greeks' pensions are almost as valuable as Germans, and their economy is nowhere near as profitable. I don't know if this is accurate or not, but what is being pushed on Tsipras and Syriza is a cut in pensions. Well, after 6 years of recession, they're back in recession, after an economy that's 25% lower, and his particular election mandate, Mr. Tsipras doesn't want to do that. So where this goes, I don't know, but the sheer intransigence, the sheer difficulty of the negotiations and the rhetoric now is not, and it should affect the euro rates. I mean, it would, on the face of it, in a very simple fashion, seem to be that you have a much greater chance now than you did 3 weeks ago that Greece is going to leave the euro. Well, if that's true, Why is the euro still sitting at 112? The answer is because nobody's buying it. Everyone in the market, at least as far as the movement and trading position goes, is still thinking this is negotiations. Yes, it's going to be a hard negotiation. You know, it's like buying a carpet. You have to threaten to walk out of the shop until you get some sort of movement on the price. That's what we're talking about. I'm not so sure. Because I'm not so sure that the Greeks and Cyprus, despite what the polls say, and I would, in this case, I would be very distrustful of polls. And remember, one thing that you have to remember about Greece is that before this all started, Greece had the largest underground economy in the EU. However large it was percentage-wise of the actual economy, it's a lot bigger now. So if you're looking for methods to survive what perhaps might be coming as far as an exit from the euro and the economic chaos that will produce, then you couldn't have a better set of training than what Greece has been going through in the past 5 years. Okay. Yes, they do, but the question is, I mean, I do not think, as far as this goes, in my opinion, I do not think the currency markets have priced in a Greek exit at all. I think what they've priced in is that they are going to solve this regardless. Perhaps you could say that the Europeans caved. That's always been my. If you're looking for a piece of logic, that's it. That the Europeans have more to lose here than the Greeks do, and in the end, they will give in. The problem with that is, and this is from both the Greek and the European side, there is no credible, sensible, logical, believable end to this problem except for the Greeks to default on their debt, period. Because even if the Greeks tomorrow, the good witch of the East, comes down and grants them access to the 7.2 billion, the Greeks are still going to need another bailout before the year is out. The logic of the situation is inescapable. What was done was to paper this over with more money and hoping. The hope has not come to pass. The only way out of it, because Greece cannot resume whatever passes for normal economic life in that nation under these conditions. The Germans and everyone else needs to be told and accepted that this money is defaulted. So back to the Fed. So the Fed wants to raise rates in September. What happens if we get between now and then? That's going to be a summer. What happens if we get a exit of Greece from the euro? Does anyone think the Fed is going to raise rates? I don't. The logic for the Fed's rate policy has fallen apart, and I don't think they know what to do with it. I have been of the belief, and I'm going to stay with it, although I'll modify it a little bit, that we are not looking at a Fed rate hike cycle in any normal sense of the word. If the Fed goes ahead and raises rates in September a quarter point, it's not going to make a bit of difference, because what a rate increase traditionally, after a period of either declining rates or flat rates, what a rate increase signifies is the start of a rate cycle. So the bond markets jump and get as much of the rate cycle in upfront as possible. That is not going to happen this time. So in a way, in a very real economic way, and market way, meaning how does it affect the markets? A Fed increase of 0.25% in September is almost irrelevant. Because even if it does happen, it does not mean that the Fed is going to raise rates a quarter point or a half a point at every subsequent or every other subsequent FOMC meeting until you get to some normal definitive rates of 3 or 3.5%. That's not going to happen. They've already said it's not going to happen. So this entire market obsession with whether the Fed is going to raise rates is largely irrelevant because you're not commencing a normal rate hike cycle. There's nothing in the economics of the United States, and I don't care what they say, but, in inflation or in economic growth that warrants an increase. There's nothing in the world economy that warrants an increase. I mean, when we looked at the central bank rate page here, where is it? I'll bring it up. Which one is rising? The blue. And what's the blue? What's the blue? The blue is emerging markets, using Brazil as the example. Why? Because their currencies were collapsing. Because all the money that went around the world, thanks to the Fed's zero-rate interest rate policy and quantitative easing, chasing return, has now reversed course. And it's leaving the countries. And what happens? Well, the real gets killed. It plummets because people are selling the real and getting their money out. Because they were only there to make short-term profits. They were not investing in any sense in the economy. This is the type of financial manipulation, if you will, that is heightened and sponsored by a zero-rate interest policy. So if economic growth in the U.S. is not really warranting, inflation is not, you can say that job numbers support it, but job numbers, one, are the only ones that are good, and two, if job numbers don't produce a rising economy, rising income, and steadily rising GDP, then it doesn't matter. Either the numbers are badly massaged, they're not the type of jobs that produce large amounts of economic activity. And many of the jobs, I don't know what the percentages, produced and are routinely touted by government representatives and other people who are in favor of the U.S. economy is getting better rationale. Many of those jobs, half often each month, are low-wage jobs. They're retail jobs. They're health service jobs. These jobs are not the kind of jobs that support a family, that support household formation, the third kid, the fifth kid, whatever it is. They're not that kind of jobs. By just looking at the overall numbers, you don't really get anywhere. So anyway, if there's nothing in the U.S. economy which is looking like rates need to be raised, I don't see inflation. I don't see job growth of the type, and certainly there's no sense the economy is overheating. You look around the world, raising rates are going to make the problems of the emerging markets worse because more money will come back. If the Europeans and others actually do end up with some sort of problem in Greece, like a default or leaving, then the amount of turmoil certainly wouldn't be something that the Fed would want to start a rate increase. In fact, in a normal world, if this was going on in Greece, the Fed would be on the hook to start cutting rates. What are they going to do? Start up quantitative easing again? So, and the last one, if you get the normal market response to a impending Fed rate cycle, that's not going to happen either. Because the Fed has already said that, and everybody knows the Fed is not going to start a normal type rate increase cycle. So in a way, all of this discussion about the Fed is kind of moot. It doesn't really impact economic reality. I'm not sure that the central banks know how to get out of this one. We shall see. Okay, folks, I have overstayed a little bit. I thank you for staying. One comment about that as far as the British exit. I don't think the British are really looking to leave. I think they're very glad that they didn't join the united currency, that's for sure. I don't think they're really looking to leave the EU. I don't think they want to change their access to European markets. I think they are looking for a different set of criteria under which they're part of the EU, but I don't think they're actually going to leave. The one thing that I will say is that if Greece does leave the European monetary union, then this will have enormous ramifications. One thing I didn't cover, of course, sorry I can't cover everything, is why are the Europeans being so difficult about this? Because if they give in to Greek demands, then why not Spain? The anti-austerity leftist party Podemos is on the rise. They're likely at this point to win the next Spanish elections. This is a big deal. And others will follow. Okay, folks. I thank you very much for listening. I'm sorry we had a few problems starting. I hope this was interesting. I hope it was a bit entertaining. It's a topic I find fascinating, as you can tell. I will type in my email address if anyone has any questions, comments, criticisms. Please, praise also is accepted. Please send me an email and I will respond today. And again, I thank you all very much for attending. I take it as a great compliment that people take time out from their day to listen to me. So I hope everyone has a great day, and I will be speaking to you in about 2 weeks again through FX Street. Thank you very much, and thank FX Street for posting this. Take care.